A credit crunch has begun, people are worried, businesses are concerned, and we are seeing that now reverberating throughout the economy. I'm going to show you why. You'll look at the stock market, you'll see it's up, it's green. We know that to be the case because the expectation of central banks cutting rates. But what's actually happening inside of the financial system and how does that affect you? All of that here today. The very first thing I want to cover is that credit crunch. Let's begin. You came here for the truth, so let me unveil that for you right here. Credit crunch has started as banks tighten lending by the most on record. This is according to, not me, but Morgan Stanley's CIO. And that is very clear because we watch this, the amount of lending that's taking place, and it's particularly evident inside of the commercial real estate side. But you can also get details from things like anecdotal evidence. When you look at Amazon businesses, a lot of these businesses here have been exiting. They call it exiting when they sell their business off to a bigger business. Sometimes they have what they call aggregators and so on, where they've just got this cash sitting there. They need cash flow and they want alternative assets, something I talk about regularly here on the channel. And so they say, I could buy an Amazon business and have this company take care of it. I'll invest, let's say they want 20 million, 50 million, and they want X amount of cash flow each month. This is a fantastic opportunity for them, especially when interest rates are low. Now that has changed and there is a lot less money out there in this case. I know that specifically, and I'm also seeing the data showing up here. Let's show you the next part of it. You could see it. Wilson, that's Morgan Stanley's Mike Wilson, pointed to a big drop in bank lending and tightening credit standards in recent weeks. The data fuels Wilson's view that the stock market is in for more pain in 2023. And I think the number that he gave was around basically where it fell in the last part of this cycle. So we're looking at that range of, let's say, 3,000 on the most bearish, and then like a 3,400 in sort of a better case scenario. That's what they say. I've heard other predictions as well. Very few people suggest, unless there is some catastrophe, that the S&P 500 will drop below 3,000, okay? And that's just because there's an expectation, hey, they're gonna print more money, they're gonna cut rates, and they're gonna make it all fine and dandy. Like really, it would really take something catastrophic to bring it down below 3,000. So use that information as you will. The data suggests that credit crunch has started, Wilson said in the note, adding that a $1 trillion in deposits was withdrawn from the US banks since the Federal Reserve began raising rates a year ago. You've got to think to yourself, what happens when $1 trillion, which a lot of these things have lost their meaning because there's just trillion here, trillion there. It's still significant because it shows you that a lot of people are worried. People are worried. Businesses are worried. They are feeling this right now and they're putting their money in other places where they feel it's safe. Now, gold is around that sort of record high, and you look at, just basic investments that are returning much more than they were previously. So you got to look at your portfolio now, and that's part of what I wanted to mention here. Take a look at where your cash is. Was it invested in the exact same things that it was invested in 2020? Maybe now's the time to look at that, be honest with yourself and ask, is this really the right thing where I should be invested in, or where my money is? Maybe it's time to trim from here, put it there. You want things that are real, things that are tangible. And if you're invested in paper assets, think companies that do well, whether it's good times or bad times. Simple matter of fact. Okay, that's the way it goes. So here we go. Look at this. The stock of State Street dropped more than 17% on Monday morning as the giant Boston custody bank said net interest income, deposits, and fee revenue dropped during the first 3 months of the year as expected because of everything that's happening with all these different banks. They're not the only one. Okay, a lot of these banks saw withdrawals taking place. Big banks, medium, large, doesn't matter the size. Whether it's a global systemically important bank, look at what happened with Credit Suisse. Perfect example. One of the biggest companies, right? And still, they encountered issues. So it doesn't matter how big the company is. It's all about what the people feel, what is the sentiment, and just like the consumer at the store will affect Best Buy and Walmart and Costco, It's the same exact situation with these banks. Okay, they are reliant on customers to keep all of their assets in the bank, or else it's a big problem. That's why when you go to the bank and you say, excuse me, bank, hi there, can I have $2,000? Whoa, 2,000? We don't have that here. You know, the alarms are going off. What's going on here? You're getting swatted. I mean, it's ridiculous. They look at you like you just committed a crime and you need to take out a few grand from the bank. Have you ever experienced that? Let me know. Put it in the comments below. Imagine trying to take out 20 grand, 50 grand, 100 grand. It's difficult. I've done it many times, trying to take out large sums. They're being nice about it. How are you today? Doing great. Yeah. So what are you going to do with the money? Okay? What are you going to do with it? I mean, they're ridiculous. They get right up close and personal with you, and they say it's for, anti-money laundering and all these different things. But let's be honest, it's much more than that. Now, looking at this with the tightening credit, this is going to impact you, your personal situation. You might be an owner of a business, or you might be working for somebody else, a big company, small company. They're feeling this internally. Inside the boardrooms that are happening right now, there's these meetings saying, what do we do? And a lot of that will then reverberate from the biggest companies down into the smaller companies. I'll show you some examples here with the commercial real estate. And so you've got to make sure that your skills are in tune, and that you are the most, if you're working for somebody else, that you're the most valuable person on your team, in your department. Very important. How do you do that? Very simple things. You have to, a lot of times, verbalize what you've done. Okay? This is important. Very key. That just telling your boss a lot of times what you've completed, even if it's exactly the same as somebody else, it's going to stick in their memory beyond the other person when it comes to review time, when it comes to, we got to cut here from there. Oh, you know what? That guy, he completed a lot of stuff, even though it was the same amount of work. It's just verbalizing it a lot of times does help. Trust me, I've tried that and it works. Okay, back in the day, many years ago. The banking situation is distinct from 2008, and it has involved far fewer financial players and fewer issues that need to be resolved, but financial conditions will likely tighten as lenders become more conservative, and we do not know if this will slow consumer spending. That's Jamie Dimon. Okay, he's saying the exact same thing. Do you see this? Increase interest rates, create worry and concern. The banking system tightens. Companies cannot expand as they once did before. Companies cannot continue with their operations. You might be saying to yourself, what does that matter? I mean, yeah, so what? They could just keep on going and maybe they can't, build more or whatever. No, most companies operate on debt. That's what they're operating on. It's literally on debt. So they use that debt because they could borrow at, let's say, 1% before. They borrow at 1% and their profit margin is, let's say, 15%, 10% even. So let's say 10% example. Okay, I've got 9%. But what happens when they're now borrowing at 5% and their margin, now we're only making a 5% margin. That's a little bit concerning, because what if it becomes 4% and 3%? It's not worth applying all of that capital. The same thing applies for Amazon businesses. If the profit margins are too thin, you're applying so much capital to get such a small percentage return. You might as well invest in what they think. They might as well invest in treasuries, right? I'll just get my 5% just like that. I'll put my money there, keep it there, I'll park it there. That's Warren Buffett. You see? Keeping it liquid, keeping it ready to go, making a small return instead of taking all that risk in order to make a small return potentially. Do you see the problem? This is what happens here. I don't think people make these connections out there in the YouTube world, and I want you to realize how the data, the news, the quotes from people like Jamie Dimon, these things affect you very much. Maybe you have a spouse and your wife is working in a job, she's working for a business. You got to understand how these things happen. Suddenly, they say, it goes from expansion to contraction, just like this in companies. I've seen it. I had the guy behind me getting fired. I've watched building, they're literally building just beside where I'm at, and then suddenly that building stops and they leave all the construction stuff just there and they walk away gone. That's the end of that financial crisis time frame. Okay, I watched it happen. They were expanding. We're going to do the most and the biggest and the best, and then the next thing you know, gone. So watch out. Okay, not just for you. If you've got a wife, if you've got a family, watch out. Okay. The U.S. money supply contracted for the third consecutive month and is declining at the fastest pace since the Great Depression, according to none other than our friends at the Fed. In February, the M2 money supply, a benchmark for how much cash, bills, bank deposits, coins, and money market funds are circulating throughout the economy, tumbled 2.24% from the same time last year. So that's big, okay? I know that the percentage it's not 100% or something, but understand that that is significant. And it shows us that when there's concern, we do have that come up, in this case here in the money supply. Very worrisome, because without an expansion of the money supply, this system will deteriorate rapidly. So they're probably going to have to do some form of stimulus, and they've already done that to some degree with the banking, the different banks after SVB failed. Really quickly, commercial real estate, big stuff here, okay, big stuff. Anticipating changing macro trends, Blackstone Real Estate shifted its portfolio away from assets facing headwinds, such as traditional office and malls, and is approximately 80% concentrated in logistics, rental housing, hospitality, lab, office, and data centers. This is a very smart move, and you should be taking the cue right here as to what's happening. Office and malls, not good. Don't touch it. If you're invested in real estate investment trusts, REITs, if you are thinking about getting into an investment with these things, if you're my friend, I'm going to sit down and tell you, buddy, don't do it. Don't put your money in that. Now they're going to go into, for instance, rental housing. Yeah, because if people can't afford their home, they got to rent. Number one. Logistics, good, but be careful, because some of the players like Amazon had to reduce their amount of warehouses, fulfillment centers, still massive, but their plans were kind of sidestepped by increasing interest rates and the slowdown in the economy and so on. And then, of course, data centers, we move more into the cloud, and that becomes very good as well. I like data centers, particularly in colder environments, by the way, because it just becomes too expensive. So keep that in mind. Little tips. You're getting all kinds of tips. If you pay attention, if you stick with me, I promise I give you the tips, I give you the data, and I connect all the dots. It might not make sense all at once, but I assure you, I promise you, this is my promise to you, that I will bring you the latest and greatest information. Salesforce gives up the last of a major downtown San Francisco office property. They are just one of them. I mean, we're talking about a company massive, one of the biggest companies, tech company, it's doing so well. Suddenly, well, we don't need so much real estate. Well, we're firing a whole bunch of people. This happens because of the rising interest rates and the concern about the future. They don't need that anymore. Growth not there, and so on. This article here, just to get into it just really briefly, they're basically talking about what's happening with commercial real estate, specifically in Toronto. But the point here is that the downtown core is basically degenerating because the businesses just aren't there anymore as they were before. Just like with Salesforce, they have a lot of people working at home. So you just don't need all that real estate, and the whole thing starts to tumble down. You've got, they're talking about people on drugs and everything and doing all kinds of, terrible things. That's happening right now today, and it's just one thing after another piling on top of each other. So all of that is happening in major cities, and I would suggest, once again, if we're friends talking, flee the major cities as best you can. If you can, probably a good thing to do. Okay, the commercial real estate sector could see a 2008-like crash, according to one CEO. We've heard this all before, but what he's highlighting here is just more of the same, in that commercial real estate has a big problem. Unfortunately, in the situation we're in, things need to bottom out, and they haven't bottomed out yet. Very important, because we have not seen interest rates come down yet. Although mortgage rates have come down from their peak, this is certainly just showing us that at this time, we are still in a concerning phase We'll see what the Federal Reserve does. Will they, in fact, be able to print a whole bunch of money in the next little while? We'll see. We'll see how they handle that. I think it's going to be a very interesting remainder of 2023. Stock market doesn't care. So just keep that in mind. I don't know why I have to keep mentioning that. I'm talking about the economy, not the stock market. But if you look at the stock market broad index, that's one thing. But as I showed you in the previous video, the average retail trader is still down 27 or 21% from a year prior. And that's because they don't know how to invest, right? They're still doing the same things that worked in 2020. Things are changing. You've got to be aware of that. Invest in the things which are solid, which are real, which are tangible. And if you're doing paper assets, you've got to, really understand what's happening in the economy today. I brought that all to you here in this video. If you need to watch it again, if you need to watch it at 2x, do that. I hope I brought you the information that you need to know. If you did, share this video with your friends and family. This is the key stuff. Do you know about the central bank digital currency that's being introduced right now? Watch this video right here, and I'm going to show you why this is something everybody needs to know, because your currency is not going to be the same in the near future. Watch this video. See you there.